In this presentation, we will work a problem recording transactions to the Capital Projects Fund and the government-wide activities. The information is going to be on the left side. We're going to post that information, record that information into the blue area on the right, into the general journal, posting to our worksheet. So our worksheet is going to give us a trial balance. We'll post to that trial balance. We'll be able then to see how these accounts are increasing and decreasing. Trial balance in order, of course, assets in green, liabilities in orange, and then we've got what would be equivalent to the equity accounts in a for-profit organization, those being in the light blue, and then what would be the income statement accounts in a for-profit type of organization, the temporary accounts, those that would close out to the equity section in dark blue. Then in the government-wide activities, we have a similar information. We're going to record the related journal entries. We'll post them to our worksheet. The worksheet having the beginning balance, the ending balance. We can then have a compare and contrast between the funds and the government-wide, between a modified accrual using the funds and the accrual with the government-wide activities. Back to our information, first transaction. We have first the issuance of a bond. The bond has a face amount of the $7,410,000, rate 8%, and sold at 101. This bond will be used to finance our construction project. We're going to put this first into the general fund because that's going to be more on an accrual basis, so it'll be more familiar to what we would expect to happen. So we're going to go back over to our general fund. We're over here in column O. Within column O, we're going to say that we're going to get cash because that we're financing. We're going to receive cash for the fund or the bond, and then we're going to issue the bond. That's going to be a long-term liability is what we would normally expect under accrual accounting. So it's going to be called bonds payable. That's going to be the liability account. And then the difference is going to be the premium in this case because we sold it for more than the face amount. That's what that 101 was. So that's going to be in the premium on the bond. So let's start with the bond amount, the bond face amount. So I'm going to say that's going to be a credit, negative in cell Q4. Scrolling back over, we're going to pick up the bond face amount. So that's going to be that. And then we're going to say, what did we sell it for in terms of the cash? We sold it at 101. So that means we're going to take the face amount and multiply it times 1.10%. 101 means we sold it at 101%. So 741,000 times 1.01, and that's what we sold it for. So let's do that calculation here. I'm going to say it's going to be negative of that number times, and then I'm just going to type in 1.01. And so that's going to be what the cash we got. The difference then is going to be the premium. We got more cash than the face amount of the bond, therefore it's a premium as opposed to a discount. This is our plug formula, negative sum. And there is our plug formula information. So now we'll post this out. We're going to say the cash first. Cash is going to be up top. We're going to be in the cash area. We're in U3 equals, and we'll scroll back over and pick up that debit. Then we want to pick up the bond payable. That's going to be down here in the liabilities section. So we are in U9 within U9 equals, and we'll pick up the credit and enter. And next we want the premium on the payable. So here's the premium. We are in U10 equals, and then we'll scroll over and pick up that premium and enter. So there we have it. And this should be kind of our normal type of transaction that we would basically think of with bonds. And so we see the debits equal the credits, back in balance, no activity in what would be kind of like the income statement or temporary type accounts below what would be the equity section or the net position section. So now we're going to go back to recording this information into the Capital Projects Fund because we issued this bond for a capital project. Here we're going to say that we have cash. We're going to say cash first. And then the other side is going to go into other financing sources because our goal here is to measure the short-term flow activity. So we're going to say other financing sources, bond proceeds. And we're actually going to not deal with the financing of it, which is the premium, because it has to do with basically the interest. We're just going to put it on the books on what we assigned for it, and that's going to be the face amount of the bond is what we assigned for the capital project. So we're going to track the face amount of the bond, and that's going to be equal to, we'll scroll over to the 7,410,000 face amount. The premium and interest then note will be tracked in a debt service fund. We're not going to get into the debt service fund with this example. We're concentrated in on the capital projects fund primarily and the government-wide activities. So we're going to say debit and credit. This is going to be our activity. And if we're going to post this out, then cash, we're going to go over to cash and say that that's going to be in K3 equals, scrolling back over, and that's going to be our cash increasing. Other side is going to go to the other financing sources, proceeds from bonds. So that's going to be here in K8 equals, scrolling back over, and then we will pick up the credit. And there is our activity for the capital projects fund. Now let's go back and see what we have next. We have number 2, grant received. So we can do this once again in our government-wide activities first, because this is going to be more like what we would expect. Although this transaction is going to be pretty straightforward either way. We're going to be in column O, and we're going to say that money was received. So that's cash. Cash is cash. It's going to be going up. So cash is going to be increasing because we got a grant received. The other side is going to be some type of revenue account. So we're going to say revenue is going to be the other side. So here's the revenue account. And the amount is going to be in cell P8. I'm going to take this and say equals and pull this from our data. Equals, and we're going to pull that from the data at the 780. Then we're going to credit the same amount. And there we have it. We can post this out. So cash first. Here's the cash account. We're going to post that up top. Something's in the cash account. Going to do this with the keyboard now. So we're in U3. I'm going to say F2 plus F2. Put the cursor back down and scroll over to cash and enter. So there we have that one. And then the next item is going to be revenue. So that's going to be down below in U12 equals, scrolling back over, picking up the credit of the 780. There we have that one. Now let's record this in the capital projects fund. In essence, the same thing, because we're basically recording the receipt of cash, and cash is fairly straightforward. We're going to say cash is going to go up for the amount received. So cash is increasing, and the other side is going to be going to some type of revenue account. So we're going to say this equals the revenue. So cash is going to go up. This is going to be equal to, once again, the 780. That's going to be the debit. So that's going to be the credit. So let's record this out. We're going to record the cash first. So if we scroll back up to cash, we're going to be in cell K3. Something's in it. I'm going to select F2 on the keyboard plus F2 so I can use the arrows and scroll back down to the debit of the 780. Second component is the revenue. It's in the credit side. That's in cell K7 equals, scrolling back over, picking up the credit. So the credit is increasing. That then puts us back in balance. Scroll back over and see what we have now for number 3. Cash transferred from the special revenue fund. So if we go over to the government-wide activity first, we're going to say, all right, cash was transferred from the special revenue fund in the government-wide activity. That's a fund-to-fund transfer. And if we think about the government as a whole, then nothing happened there because it went from one fund to another fund. So we're not going to record it actually in the government-wide activity. Nothing really happened there. Went internal transaction, one fund to the other. Then we're going to record it in the capital projects fund. And there we're going to say cash is increasing. So we're going to increase the cash because it's going to be going into the capital projects fund. And that's where we're focusing here, of course, the capital projects fund and not the special revenue fund. So, and then the other side is going to be equal to what would be kind of like a revenue account, and it's going to be other financing sources, and it's going to be an interfund transfer. So interfund transfer from one fund to the other financing sources. We're going to pick up the amount. Then cash is going to be increasing for the fund we're concentrating on, the capital projects fund. We're not going to be recording this on the other side, the special revenue fund, which would be basically the opposite of this type of transaction. And then we're going to say the credit here. And there we have that. Now let's post this out. We're going to go to cash first. Cash is going to be up top. I'm going to do this with the keyboard. Once again, I'm in K3. I'm going to say F2 plus F2, scrolling back down. And we're going to pick up that debit and enter. And then the next item is going to be the other financing sources. So other financing sources, interfund transfer in. We are in K9 equals, scrolling back over to the credit, the 395 and enter. So that puts us back in balance. Let's see, the next transaction that we have here is going to be number 4, construction contract awarded. So now we're going to be the government. We are awarding the contract then to a contractor. So we have awarded the contract to a contractor for construction. Now, if we think about that, we didn't actually do anything yet because we've signed a contract and said we expect you to do the construction progress and get it on the way, but nothing else has really happened yet. So if we think about that from the standpoint of the government-wide type of activities, you could think of this as a similar kind of thing. It's an estimate in a sense, or you could think of it as a similar thing as sending out a purchase order for a for-profit type of organization. If we sign a contract to do something, or if we send out a purchase order requesting something like inventory, then there's something that's happened that's valuable, that there's something there, but it's not a financial transaction. We don't usually record it on the books, because if we sent out, say, a purchase order or signed the contract, we haven't received anything yet, and we haven't paid for anything yet. So in terms of financial accounting, we don't record anything yet. So on the accrual basis with government-wide, then we're not going to do anything. It's similar to like if we set the purchase order. We track the purchase order. We haven't done anything yet. Here we signed a contract to do something in the future. Nothing has yet happened. No financial transaction. However, if we're looking at the capital projects fund, it is going to be on that modified accrual basis. And again, this is similar to when we basically send out the invoice if we were talking about the general fund, and we're going to do the same kind of process. We have the estimate, and therefore we're going to record the allocation of basically the funds. In essence, we want to be able to record kind of the flow before the flow happens, because we want to be as transparent as possible that we've had the commitment that has been committed, even though there's no financial transaction under an accrual or even modified accrual basis. We use then that encumbrances account to do that. So we're going to say, okay, it's not an expense or an expenditure, it's going to be an encumbrance. So we're going to say this is going to be equal to the encumbrance. And then whenever we have encumbrances, we put the other side, because we don't know where it goes, because it's some funny account. So we just stuff the other side into like what would be an equity type of section account. So the equity section type of account is always going to be equal and opposite to the encumbrance income statement kind of type account. That would be equivalent to a for-profit, obviously fund balance type statement, and the related income statement or temporary type of accounts. And this is going to be equal to the amount of the contract awarded. There's going to be our debit and credit. So if we record this out, then we're going to say that encumbrances is here. Here's the encumbrance. It acts kind of like a temporary account. Remember, however, I would think about this as more as like a clearing account. It's going to go up, and then once the encumbrance has been fulfilled and we can record something on closer to an accrual basis or a modified accrual, we then want to record the expenditure. And in order to do that, we'll have to reverse the encumbrance. So it's going to go up, it's going to go back down, not going back down simply because of or only because of closing out as all the other temporary accounts do, but it's going to go back down because we're going to decrease it to record the actual expenditure. Typically is how it's going to do, is when it's going to decrease. Okay, so we're going to record the debit. There is that amount, and then the other side is going to go into encumbrances outstanding. That's going to be in what would be the equity section or the fund balance section, equals the credit. So there we have that amount. There is our debit and credit. That puts us back in balance. Let's see what we have next. Scrolling back over to the data, number 5, we've got the construction expenditures. So construction expenditures totaling out this. We're going to break that out into our categories of land, building, and equipment. And we're going to say that basically after these expenditures, the construction project is over. So the project is done at the end of this point in time. So let's scroll over to the government-wide activities. We're in column O, and this is going to be more kind of familiar to what we would expect to happen. Again, it's a little confusing because if we've worked in for-profit accounting, we may not have worked for basically larger construction type of contracts where we're dealing with work in process type of activity. But if you have, then this is going to be similar. It's going to be similar to an accrual type of basis in that we're going to be capitalizing this activity as an asset rather than expensing it when we basically go through the construction process. So here we're going to say that these costs are related to the construction process. And whenever we build like a building, if we were going to build a building, in essence, what we do is just basically everything that's going to be the cost of the building, we're going to increase the asset, which is going to, in essence, be the building or whatever we're making. But before we do so, we're going to put it into work in process. So we're going to put it into work in process. So all this activity, until it's completed, we're just going to debit to an asset account, not an expense account, work in process type of account. So we're going to debit then the work in process for everything that's going up into an asset type of account, construction work in process. And then the other side, we're going to say this is the cash that we spent during this time period. Now, all the stuff we spent is in the work in process. And note, obviously, if you were to break this out into what did we spend it on, you use probably a job cost type of system. We're not going to get into job costing and whatnot, but you would, in essence, track it out with a subsidiary ledger within a job cost system possibly. But here, just note that this on the normal accrual basis, we're increasing the work in process, and that's going to be equal to the total amount that we spent, no matter what we spent it on, because it's going into the work in process account. And that's going to be our first transaction here. So we're going to say, all right, let's post this work in process, scrolling back up. Here's the work in process account, the asset account. We are in U4 equals, scrolling back down, and we will then pick up that debit and enter. Then we're going to pick up the credit that's going to be going to cash. There it is. We're going to scroll back up, pick up the credit in cash in U3. We're going to do that with an F2 plus F2, scrolling back down and picking up the credit. So there is the debit, there is the credit, increasing the construction work in process. Now what we're going to do is say, all right, now the thing is done, the construction process is done, so we want to take it out of work in process that basically says, hey, it's not quite done yet, and put it into the accounts that represent what has been constructed, in our case, land, building, machinery, and equipment. This is what the project did for us. So now we're going to take it out of the work in process, we're going to put it into those categories. So we're going to credit work in process for the entire amount, allocate it to land, building, and machinery for the amounts that are relative to them. So we're going to say, all right, then the work in process is going to go down. It's going to be a credit. We should put it on the bottom. So it's going to be land, building, machinery. I'm down here on U23 equals. Let me do that one more time. I'm not sure I did that right. 1, 2, 3. Yeah, U23 equals. And then we're going to say this account's going to go down. The construction work in process is going to go down. And then we're going to pick up the land. And then the building is going to be debited. These are going to be debited. You're imagining this journal entry as it's being constructed. And then the machinery and equipment. So these three are going to be debited. Those are the assets now. And we're going to credit the work in process asset, taking it out of one asset, putting it into the other assets. We're going to pick up these amounts from our data of the land. We are in P20 equals. We're going to scroll to the left to pick up that land. That's going to be the 270 and enter. Then we're in P21 equals. I'm going to scroll to the left and we're going to pick up the 365, enter. And then we're in the machinery and equipment equals, scrolling to the left, and we want to pick up the equipment and enter. Then we have the negative sum or the plug formula on the other side of things. And there it is. So we're going to, there's our transaction. Let's post this out. Land first. So we'll scroll back up into the land area. We're going to be in U5 equals, scrolling back down within land, picking that item up. Next, we're going to pick up the building, which is going to be this one in P21. So we're going to go up to the building. We were in U6 equals, scrolling back down to pick up the building. There it is. And then we're going to go to the machinery and equipment, this amount. So machinery and equipment, we are in U7 equals, back down to the machinery and equipment, and enter. And then we have the construction work in process lastly. So scrolling back up to the construction work in process, we are in U4. This time I'm going to use the keyboard, F2 plus F2, scrolling back down, picking up that credit and enter. So there we have that. So now we've moved it out of the work in process and we've put in our land, building, and machinery and equipment. Let's scroll back over and see what happens with regards to the capital project fund. So we are now on number 5, capital projects fund, cell E17. Within the capital projects fund, of course, we're not going to be recording the asset, long-term assets, because this is a flow fund. This is the modified accrual. We're trying to see the activity, the flow of the activity as it goes through the capital project fund. Therefore, we're going to be working down here. Now, what we want to record is the flow of the capital project, which we're going to record in construction expenditures. So we're going to record it as the expenditures, kind of when, more of when it happens, rather than putting it on the books and work and process and then to the building, to the asset. So before we do that, we have to reverse the encumbrance. So now we're going to say that the construction expenditures have happened. We want to record them now, and we can do so under the rules of the modified accrual basis because the transaction has actually happened at this point in time. We spent the cash for it. However, before we do that, we want to reverse the encumbrance, and this would be the same kind of thing as we would see in the general fund when we send, say, an invoice out for supplies or something like that before we get the supplies. Then we have to reverse the supplies to record the related expense or the asset of supplies when we get them. Same kind of activity here. The only added little kind of twist on this, the thing that's a little unusual, is the fact that we're recording construction expenditures as an expense in any case, because you would think that it would go on the books as an asset. But the whole point of the capital project fund is to track the flow and not record, and we're not looking to record the capital project asset, but we're looking to record the flowing of the activity. All right, so we're going to reverse then the encumbrances account, and then we'll record the construction expenditures. So the encumbrances is on the books as a debit, and then the other side, of course, is into encumbrances outstanding. Those two always equal and opposite. We're going to reverse them exactly. So we're going to scroll back down, and we're going to say that we now need a debit to the encumbrances outstanding, and then the credit is going to go to encumbrances. There's our transaction. We're then going to pick up this information, and I'm just going to reverse it exactly. So we're in F17. It's going to be negative of this number, flipping it. Oh, I'm sorry. It's going to be equal to this number because we don't need to flip it. We flip the order of the accounts. And then the next one is going to be a credit, and we're just going to reverse this exactly. So let's do that first, and we'll be back to where we started in essence. We're going to scroll back up to cell K6. I'm going to do this with the keyboard again, F2 plus F2. Scrolling back down, and we're going to pick up the debit of encumbrances outstanding and enter. And then the next item, of course, is the encumbrances. Here is the encumbrances. Here we are in encumbrances in K10. Something's in it. I'm going to say F2 plus F2. Scrolling back down, we're going to pick up the credit of the encumbrances and enter. That brings it back down. Now we're going to record what we want to record, which is the expenditure of the expenses that happened, the flow that happened with relation to the construction process. So we're going to say that this is going to be a debit to the construction expenditures, the expense-like account. And then we're going to scroll back up and pick up the other side, which is cash. So we're going to record the activity. The activity here being the construction expenditures. And there is going to be the $8,568,000. And the other side is cash. So there's our journal entry. Construction expenditures, let's record that first. We're going to scroll back over, picking that up in K11 equals, scrolling back down, and we want to pick that up this here, and there it is. There's that item. And then the other side is in cash. So we're going to scroll back up to cash. So cash here in K3, F2 plus F2, scrolling back down. And we're going to pick up the cash and enter. So there we have that. That puts us back in balance. Let's scroll back to our activity. We're going to say that now we are on number 6, which says capital projects account closed to the fund balance restricted. Capital projects fund closed by transferring remaining funds to the debt service fund for use in construction project debt repayment. So now we're going to close out the construction project. So note what has happened here is that the construction project is over because now we've got the construction project completed in the general fund. We moved it from the work in process to the completed items, which was land and the equipment and the building. So that means the capital projects fund here now has served its purpose. It's done, served its purpose. We saw the flow, we saw the activity throughout the construction process. Note we're left with in this fund $17,000. It's already been finished now, so we can close the capital project fund because it's served its purpose at this point, tracking the flows for the capital projects. We still have $17,000 in it. We need to take it out of it. We're going to transfer then to the debt service fund because that's where we're tracking the debt that financed this project, including the bond that we used for it. Well, no, obviously the bond isn't here because we're tracking the payment of the bond and the debt service fund. So what we're going to do now is close this out, which is going to be similar to a for-profit type of activity. All the accounts below what would be the equity section, in this case the fund balance section, are going to be temporary accounts. We're going to close them out to what would be the equity type accounts, and then we're going to have to do something with that 17,000. That's what we're left with, and we're going to transfer that to the debt service fund, because that's where it's going to go to service the debt that we had to take on in order to pay for this project. Okay, so let's see what that's going to look like. The way I would think about closing these items out is just line by line. So I'm not going to go by basically, in essence, putting debits on top. The debits will end up on top in any case, but note what we're doing is closing everything from the blue accounts down, just like we would in a for-profit organization. If we go line by line, we say this is what's in there. I'm going to close it out. I'm going to close each of these out individually to the equity accounts, or what would be the equity accounts. So we start off with revenue. It's got a credit balance. We're going to do the opposite thing to it in order to close it. So I'm going to scroll back down and say that our first account is going to be revenue. So here is the revenue account. And what does it have in it? It's got a credit of $780,000. So that's what we need to debit then. I'm going to debit it for $780,000 to make it go down to zero. And then the next is other financing sources. That's another kind of revenue, similar type of account. That's how we finance the things, inflow. It's got this amount in it. It's a credit, so we're going to debit it. That's the bottom line right now. We're going to debit for whatever is there to make it go down to zero. So we're going to debit the other financing sources, and that is going to be for the 7410. So that's going to be a debit 7410,000. So there we have that. And then the next item is going to be a credit to other financing source, the Interfund Transfer. That's the one that we transferred from one fund to the other. Another kind of similar to an inflow, kind of revenue type of activity, has a credit. Therefore, we need to debit it to make it go to zero. The amount in it is $395,000. So we're going to debit it for $395,000. And then the next thing we have here has this $8 million in it. That's in the construction expenditures. It's got a credit. It's got a debit. Therefore, we need to credit it, do the opposite thing to it to make it go down. So we're going to credit that one for the construction expenditures. The amount then being 8568. 8568. So we're going to say negative 8568. And there we have that. So that's going to close that out. That'll close everything out, and then we're going to be left with some kind of difference, which we can see here. Sorry for all the scrolling. Is the 17,000. Right, that's the difference. So we're going to say, where's that going to go? Well, the debits are less than the credits, so we need a credit. So I'm going to put it here, negative sum, plug formula, negative sum of these items, which is basically the credit minus the debit, debits minus the credits. In other words, we need 17,000 in order for the debits to equal the credits. Where are we going to put that? Well, that would normally go to like retained earnings or capital if it was like a for-profit organization, some type of equity type of account, which would be the light blue type of section here, some type of assets minus liabilities, fund balance type of account. We're going to put it into the fund balance restricted. So fund balance restricted, that's where it goes. So we'll pick that up. And there we have that. So there's our journal entry. This is our closing journal entry. We're going to close this out. So revenues first. Here's revenue. Here's revenue up top. Something's in it in K7. I'm gonna go into it by saying F2 plus F2. Scroll back down and pick up the revenue. And then the next item is right underneath it, of course. That's going to be the other financing sources. So right underneath the revenue, we're in other financing sources, K8, F2 plus F2. Scrolling back down, and we're going to pick up that 7,410,000, bringing it down to zero. Next item we have then is the other financing sources, the 395. That's going to be right below. Here's the 395. We're in K10, F2 plus F2. Scrolling back down, and we're going to pick up that other financing source and enter. So that brings it down to zero. Next, we have the construction expenditures. There's the construction expenditures. Scrolling back up, we're going to pick up the construction expenditures in K10, F2 plus F2, scrolling back down, construction expenditures. That brings it down to 0. And finally, the last item here goes to the fund balance restricted. So we're going to scroll back up and pick up the fund balance. That's here. We're going to say this is equal to. Scrolling back down, and we will pick up the 17,000 fund balance. So that does it. It brings all of our kind of temporary accounts. The temporary accounts, close them all out to what would be the equity section. In our case, of course, the fund balance section. Now we're left with 17,000 in cash, and that's going to be in the fund balance. And this, we don't need this anymore. We're not holding on to that 17,000 in the capital. So we're going to put that somewhere. We're going to, in essence, want to transfer it to the debt service fund so it could be used for the interest, as we said. So normally we do that. We should record that to the other financing sources and transfer it. So the other financing uses to get it out of there, and then we could close it out. So we'll do this with a two-step process. So we have cash on the books, 17. We need it to go down to 0. We're going to record it in the flow, other financing uses, as we transfer it to the debt service fund. So we're going to transfer this to the debt service fund. We're going to credit cash. So I'm going to say cash is going to be credited for that 17. Credit the 17. Then we're going to debit something for 17. And the debit is going to go to that other financing uses. Other financing uses, because it's going to be, and it's going to be a transfer out. Where's it going? To the debt service fund. So here's the other financing uses. We're going to debit that. So scrolling back up. And we are in K12 equals. And we'll pick up the other financing uses. And there we have that. And then we're going to scroll back up and go to cash. In K3, F2 plus F2. Scrolling back down, and cash is then decreased. So now we've moved it out of cash and we've recorded the flow that's happening. Now we need to do the closing entry for this. So now we need to close this out to the fund balance, which will make everything 0. So now we're going to say, all right, now I'm going to close this out. That has a debit in it. We're going to credit it and put it into the fund balance. So we're going to say fund balance is going to be this one. That's going to be our debit. And then we're going to credit other financing uses for 17,000. And there we have it. So this is going to be our final thing to close everything out for the capital project fund. So here it is, fund balance. Scrolling back up, we'll pick that up. Something's in the fund balance. So I'm going to go to the F2 plus F2, scrolling back down with the, or using the arrows to go back down to the fund balance, and enter. So there we have that. It's been decreased, and then we're going to record the other side to the other financing uses in K12, F2 plus F2, then using the arrowing back down, arrowing back down, arrowing, and then we're going to go to the 17 and enter. So there we have that. And so now we've done the capital projects fund. So that's, you know, an example of basically the increase in the capital projects fund, and then the decrease, and finally closing it out. Obviously that would happen typically over a long period of time, but that's kind of the life cycle of the capital projects fund. We're going to finance it, we're going to increase it, and then the capital project will end, and then we're going to take it back down. As we increase the capital projects funds, you'll note that we don't see the assets as you would expect under an accrual basis. We're recording the activity that's happening in more of the income statement or temporary type of accounts. And then at the end of the day, at the end of the project, we'll close this thing back out.